As we head into the last few weeks of 2025, what does the economic picture look like for business owners? How does one navigate stocks near record highs, a Fed that is expected to cut rates again, or ongoing policy updates? Well, we're going to answer those questions and a whole lot more right now on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for joining me today. My guest in the studio is Paul Shao, Asset Allocation Strategist with CIO Americas here at UBS. Paul, good to have you.
Thanks for having me.
So we're going to be talking about what's going on with business owners, particularly as the CEO presentation. We talk about this on a quarterly basis.
Yep.
And it's an interesting time right now because we're getting ready for the end of the year. We're seeing a really interesting macroeconomic picture. Stocks are near all-time highs. We've got a Fed that will probably be ending quantitative tightening, and they're continuing to cut rates. There's a lot happening. So let's talk about the macroeconomic picture because, throughout the year, there's been this question of, are we going to maybe start seeing a bit of a dip and maybe a recession? Is it on the horizon? What's going to happen when the Fed does start cutting rates? Where are we right now? What are you seeing when it comes to the economic picture here in the U.S. and globally?
I think that's a great question. And just to start out, we're still in a government shutdown, and I think that's harder to feel from a market perspective when we're coming up with new highs, we're getting ready for earnings season, but we're still very much in a government shutdown. And for us looking at the markets and at the numbers, what this means is we're flying blind to some extent because that limits the releases for a lot of economic releases, such as jobs numbers, which we're supposed to get at the top of the month. And coming into November, it's unclear whether we will get jobs numbers for October even. So we do have a view on the macroeconomic picture, but to some extent we are flying blind. For the indicators that we do have, they look actually really good. Coming into 2025 after the election, investors knew that there will be some policy volatility, definitely a growth hit from tariffs. And a lot of those fears, those most pessimistic fears, I think have been alleviated from that point. Atlanta Fed has this GDP tracker that we look, and it's closer to 4% tracking for Q3. And so if you average that for the rest of the year, that looks like we thought growth might be below 1% or quite weak this year. Some people called for a recession. It looks like growth is actually tracking much closer to trend this year at 1.8 to 2% for an annual basis. And for inflation, we see some tariff effects for a select number of products, but overall inflation is still very, very modest, at least when it comes to the tariff related effects. Remember, inflation is expected to be maybe 3%, average 3% annual pace for the next couple of months. It's so much lower than the 9-10% rate we had in 2022 when you had that supply chain sort of shock. So all that stands for it's a good macroeconomic environment for risk assets. In the sort of the way we talked about in the house view, it's very much in the reflation area of things, which tends to do well for equities right now. So the macroeconomic picture, I think, is quite benign for risk assets.
Right. And it's interesting because, we are kind of gearing this topic really towards the business owner side here, and we're getting into the holiday season, so shopping will kind of start to pick up, we think. And the fact that tariff effects have mostly been muted so far, it seems like perhaps we might see a successful holiday shopping season for the retailers because at this point, earlier this year when we were thinking about tariffs before Liberation Day, there was a lot of question about, well, what is that going to do to the bottom line of what consumers are going to pay for, at the stores or, for other goods. And so it seems like we're not really much different than where we were before a Liberation Day. Okay, I want to shift over to equities with you, though, because this has been quite a story. I mean, a lot of it being led by artificial intelligence and overall technology. I mean, the NASDAQ itself, it's up 22% year to date, on track for breaking records if it continues on this trend before the end of the year. S&P also heading into the final week of trading for this month, for October, on track for a sixth straight monthly gain, and it's up 17%. The question is, do we have more growing and staying power when it comes to equities, or if we maybe are starting to see a bit of a peak? What are you seeing?
I think it's impossible to talk about equities without acknowledging the AI story. And if you look at the companies that have been the great revenue generators, that have been pushing up earnings estimates for aggregate equities, they tend to still be really well. And that's also behind our upgraded equity view going into the final months of the year. Our earnings has been much more resilient than expected. It's largely coming from these large AI tech stocks. But I will say, I think the one encouraging thing for equity investors is also somewhat of the broadening that small cap stock, the Russell 2000, has also been picking up quite lately. But I think is another as a result of just the overall U.S. economy is doing, because as interest rates go down and as the domestic economy continues to perform, that tends to benefit smaller cap stocks, whereas the larger cap stocks are more internationally exposed. They have healthier balance sheets, and they are usually more focused on the bleeding edge of tech, which in this case is artificial intelligence. So going into earnings season, I think pessimists have been wrong for the last couple of quarters. Earnings are shaping up to be resilient, and that is behind the significant rallies we've seen in the indexes you've announced, the NASDAQ and the S&P.
Right. Yeah, and we're talking about coming off of 2 years in a row, 2023 and 2024, where the S&P 500 was up 24-25% each year. So equities have just had this massive run. So I think it's a natural human instinct to wonder, well, when is that going to just stop and turn around and go the other direction? But the fundamentals, like we're talking about, they are there. We're still seeing so much investment, capital expenditures when it comes to artificial intelligence and all the related, adjacent businesses that are affected by and part of the AI story. It's fascinating. We're going to look back at the textbooks one of these days and see what an interesting story this really will play out to be. I want to talk also about, because we're looking at, there's a lot of obviously policy changes. With any administration, you're always going to have policy changes. But I think one of the things, and I saw this in one of your recent reports, is that there is a little bit of anxiety when the consumer is concerned, and seems to be that there's sort of this feeling of the unknown and not knowing exactly what's coming next. So from a policy perspective, what can we expect as investors, as consumers, when it comes to the things that are happening from the policy world?
Sure. I cannot remember a more, call it, White House-driven market compared to any year that I've been before when it comes to just the amount of tariff announcements, OBBBA, private-public sector partnerships. It definitely does seem to be a large market narrative for this year. Going into next year, I expect policy, or at least volatile policy, to be much less of a story for several reasons. One, on the tariff front, which looks like one of the White House's preferred instruments. The legality of it is still coming into question, and the Supreme Court, I think, is going to rule on IEEPA coming into January, and if it's unfavorable, I think that limits the scope of tariffs going into next year. And frankly, I think investors are just becoming more and more used to these announcements, and I wouldn't say shrugging it off, but having less of an impact. Just in the last week, we had, over the weekend, increased tensions with Canada, but also a framework deal with China. So there is added layer of complexity. It's harder to tease these things out relative to Liberation Day, where it's just blanket tariffs on everybody. So I think there should be less volatility on the tariff front going forward. On the monetary policy front, I think it's clear that the Fed wants lower rates, the White House wants lower rates, most of the people in the economy wants lower rates. So for us, it's pretty clear the direction of things, unless we have that big inflation surprise from tariffs that we're just not seeing materializing so far. The sort of slowdown in the labor market, I think, is enough reason for the Fed to keep lowering rates. And from a policy perspective, I think the White House hasn't been shy about its disagreements with the Fed. And since Jerome Powell's term is up in 2026, I think we can expect an announcement of change in leadership before the year's end. Most of the market expects a sort of structurally more dovish Fed going into 2026. And in fact, if you look at futures pricing, they're a bit more dovish than our CIO forecast, which is already calling for several more rate cuts. So we're expecting even more than that.
Yeah.
So I think from both a policy perspective, from monetary policy perspective, it's still generally tailwinds for, I think, markets, because you're getting less uncertainty and also lower interest rates going forward.
Yeah, and hopefully that will reduce some of the anxiety that consumers are, feeling out there. Last question, and we only have about a minute left, Paul.
Yes.
Just, what else should business owners be keeping in mind? Because you did mention a couple things out there, the OBBBA, which is called the One Big Beautiful Bill, and a lot of the AI-related stories that are out there. What else should they keep in mind?
Sure. I think just tactically in the next couple of months, one of the effects that I don't think is much paid attention to by markets is just the stimulative effects of OBBBA in the coming months. You have much more cash on hand for many businesses that OBBBA impacts, but also policies like no tax on Social Security and tips. Presumably those refunds will take effect during this tax season that might help boost the consumer. And also the White House has been talking about refunds for companies that have paid tariffs, which can also be a pretty significant stimulus to the economy going into Q1. And in fact, we do have a chart on screen right now. The blue line is the Congressional Budget Office as current estimate of what growth would look like, and you see how it's so much higher than the gray lines of their initial forecast that they made before OBBBA was passed. So that sort of stimulant impact will be felt the most in the first half of 2026. You'll have some of it towards the end, but that's something that I think businesses should be aware of. And another thing that I think you might have touched on is the increasingly K-shaped consumer, where the top 10% of consumers are making more than half of overall purchases. And since though that cohort tends to be equity owners, and equities are doing really well right now. In fact, you mentioned that spending season might actually be in aggregate quite good, even though you might have a much more differentiated impact across the income cohort. And lastly, the third thing, and I think it's not really a surprise for businesses right now, but a lot of the investment, whether it's VC or just business investment right now, is still going to the AI trade. So right now, our belief in the U.S. equities, U.S. assets, it's really hard to disentangle that from the overall bullishness on AI. So that's something that businesses should also be aware of.
Yeah, a lot there to unpack, Paul. Thank you very much. Good to see you, and obviously a really interesting time in the markets right now with so much going on. There's always a lot to discuss with you. Great to see you, Paul Shao.
My pleasure.
Thank you from the Chief Investment Office. And thank you all for joining us. There's more information on our Insights website. You can find that at ubs.com/views. Plus, you can follow UBS on social media. We're on LinkedIn and Facebook. Plus, check us out on Instagram at UBS Trending. Lots of great content there for you as well. And if you have any questions about what Paul and I spoke about today, make sure that you are chatting with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.